So it's always good to frame the markets and sort of get some expert views on where things sit at the moment. It's been a difficult time for mining finance raising, throughout the year in general. But why don't we start with the sort of macro side of things and get a view on some of the drivers behind, high interest rates and inflation, how this is impacting the gold market, and where the panel see this perhaps playing out as well. Adrian, I always like to start with yourself, just as a sort of that macro picture. Could you give us your thoughts on where we are, considering we were on this panel a year ago?
Well, I mean, this time last year, everybody expected the Fed to be cutting rates at some point in 23, and now everybody's expecting the Fed to start cutting in 24. I don't know. I think the question is Jerome Powell the guy that Donald Trump thought he was, or he found out that he was, which is a high rates guy, not a low rates guy, which is what he thought it employed. If you look at the range of forecasts for Fed funds for the end of next year, it's pretty wide. I think Goldman Sachs reckon there'll be one cut from 550 to 525. UBS reckon it'll go all the way down to 275. So basically halving the Fed funds rate over the next 12 months. What's interesting, if you look at the UBS forecast, is that you've got to assume that's predicated on a pretty nasty recession. But if the US were to go into recession and it were to play out in the way that the Fed have responded with interest rate cuts in the past, 275 would not be the floor, I don't think. During 2019, the recession scare and then into the COVID catastrophe, they obviously cut rates as low as they could, but they didn't go below zero. So that came in at about a 2.5% rate cut. But if you look at previous cycles where the Fed was actually at rates where they are now, next year could be 4%, 5%, to get as low as they might go, unless Jerome Powell says, okay, there's a recession, but we always knew this was coming. Part of the plan is to slow down the economy. And therefore we won't go to zero, we won't go to one. So that's the curveball, I think. Now, in terms of how precious metals respond to that, I would suggest that financial markets more broadly, that's a huge risk point, particularly for the NASDAQ, particularly for kind of go-go US stocks. If you look at what's happening in US equities, broad equities, not just mining right now, it's all about interest rate expectations. And the financial markets are still utterly reliant on Fed expectations for the direction of travel. If you look at the mess that the US is in fiscally, and you look at, what the disaster that's been in Treasury bonds, government bonds, 30-year Treasury is now seen as a risky asset, and the wipeout that you've had in long-term debt prices. Where do you go from here in terms of asset allocation? Do you start buying Treasuries again because you think that they're going to start cutting rates? So I think that's going to continue next year being the real point of interest. Inflation clearly has come down. The UK government has halved it. Well done, very good. I don't know if they actually had anything to do with that, but they can take the credit if they like. I don't think the Bank of England had anything to do with that. I think most of it was to do with the shock of reopening, firstly, and then obviously the Ukraine invasion by Russia. That's worn off. Oil prices are struggling to stay where they are, despite OPEC Plus's best efforts to try and restrict new output or put in a production cap. So in terms of inflationary pressure, I don't see that evaporating, but I certainly don't see it coming through very strongly next year. And against that, you've then got this tussle, I think, with central banks. Under Jerome Powell, Bank of England keeps saying it, Andrew Bailey said it yesterday, Lagarde keeps saying it for the ECB, we're going to stick the course. This is higher for longer. And in a world of positive real rates, you would expect gold to be doing badly, but it isn't. The Fed is now positive. If you look at the upturn in real interest rates, if you look at the TIPS, inflation-protected Treasury yields, the most enormous rise over the last 2 years, and gold didn't dump. So something has really changed in the way that gold tends to respond to interest rate expectations. I think that pattern is still there, however, and I think that is where gold will probably ebb and flow in price next year, is on broader market expectations for what the Fed do. And I think it's not just precious metals. I think it's the whole market. All financial markets are going to be on a hair trigger as to what those expectations are.
Excellent. Touched on a lot there. We'll unpack bits of that as we go. But What about the buying? Who's buying the gold at the minute? And what about this price?
Nobody is buying gold at the moment. I mean, other than central banks. I mean, private investors on BullionVault are net sellers at these prices. And they have been every time the price has gone above 2,000. We're seeing it in silver again on last week's big pop. Because existing precious metals owners, physical owners, are now being offered in gold the highest prices ever. And they can cash out and put 5% in the bank. You know, this is something we haven't seen for 20 years, 15 years, you know, since you've had interest rates like this. So there's a real headwind. If you look at what's happened, for instance, to the German coin and bar market, a real phenomenon over the last 10 years. Germany has become, I mean, at one point it was the third largest consumer gold market in the world, overtook the US. And Germany, real phenomenon was that there's no jewelry demand to speak of in Germany. It was all coin and bar. Huge, huge inflows. Completely evaporated at New Year. As soon as the ECB got above zero with its nominal rate, suddenly German consumers said, oh, and there's record high prices. And that background noise of negative rates in Germany across the Eurozone, I think, had played such an enormous part in Germany's gold demand over the last few years. I know a lot of German coin dealers, especially the newer ones who are new to the market, they've never seen people ring up and sell. You know, they were shocked. The phone rings and the guy on the other end says, I'm looking to sell. What? This is really new to them. More like the gold market of 20, 25 years ago. So we also know that larger investors, managed money, they're not buying, look at ETFs. ETFs are on track for a third year of outflows. We don't know quite what's happening in allocated London and such accounts, but I think if ETFs are shrinking, you can pretty much bet there isn't real money going into allocated gold accounts. You know, it would be very weird if that wasn't the case. So who is buying? Well, jewelry consumers, India and China, both looking relatively strong. Even at the start of this year, India and Chinese jewelry demand was back to pre-pandemic levels, but at a price $500 an ounce higher, which I think is very supportive for the market. And then, of course, the key issue really is central banks, and primarily the Chinese central bank. I mean, it really looks as if the People's Bank of China is a buyer of gold at any price. They've got enough dollars to not really care what price they're paying for gold. It's the world's #1 gold mining producer nation. They're looking to diversify away from the dollar, de-dollarize, whatever you want to call it, for various geopolitical reasons. They look at the example of what's happened to Russia in terms of sanctions. Venezuela, I think, is a great example of if you leave your gold at the Bank of England, what might happen to it if the Western powers decide that you're not playing by the rules. So the central bank demand, I think, is obviously crucial as a support for the market. Has it been driving prices higher? I think possibly yes, which would be new. I think that would be a new thing. But as I say, the Chinese central bank, I think, is a buyer at pretty much any price. And then the other source of demand, in inverted quotes, really is COMEX speculation. It's what we saw on the Hamas atrocities. That price popped back over 2,000. That was all in the COMEX. There was nothing happening in physical there. The ETFs didn't expand. Coin and bar investors took profits. BullionVault customers took profits on that. So at the moment, what the market lacks in terms of buying pressure is investment demand, private investment demand. You could say maybe, if this was happening in an economy, you'd say that public sector is crowding out the private sector, right? But, central banks at the moment are really the only game in town.
Yep. Excellent. Ian, can I draw on you as the asset manager on the panel here? Can you give your views on some of the points that Adrian has raised, and also, how do you see this the market at the moment with this high price but lower interest?
Yeah, fairly similar, really. I mean, the big buyer of physical gold bullion are Asian central banks, primarily China. They don't buy silver and they don't buy mining shares. So they've been buying gold. They hold, or did hold about a year ago, over $1 trillion of US Treasury bonds, and they've been gradually diversifying that out into gold bullion for obvious reasons, really. I mean, Russia did the same. Russia had 600 billion of US Treasury bonds and switched the whole lot into gold. prior to its invasion of Ukraine. And if China's going to make a move on Taiwan, it will move all its money out of US Treasury bonds before that. Otherwise, the US government will just confiscate the Treasury bonds. So that's what seems to be driving gold bullion. And looking at the other commodities, I mean, as I say, you've got a war in the Middle East, the oil's going down. There's no interest. The commodity markets, apart from gold, which is in a world of its own, are signaling that we're going to have a recession next year. The commodity markets are telling you that. And it potentially, our view, because we run a bond fund as well, our view is that it's going to be a nasty recession. That's the outlier bet. The consensus view is it's going to be a soft landing or no landing at all, and everything's going to be great. We don't buy that at all. We think the recession next year is going to be far worse than what the market's pricing in. And as a result, we see big gains in the long end of the global government bond markets. We think they're going to have a serious upward move now. They've been falling for 3 years, and we think they're going to have a really sharp rise. So like what Adrian said, we see the 50-year gilt or 30-year Treasury bond coming down to sub 3% yield. We think the Fed, having got it wrong by keeping interest rates at zero for far too long and letting the inflationary genie out of the bottle, they're now making the same mistake the other way round. They've pushed up interest rates. This is the biggest percentage rise ever you've ever seen in interest rates in such a short period of time. They've over-tightened, and they're now saying, I mean, higher for longer, or, it's only 2 years ago. If you look at what people like Kashkari were saying, they were saying lower for longer. They were saying that Kashkari was actually said on record that interest rates would stay at zero till 2025. He's now completely flipped the other way and saying that rates have to stay higher for longer. So you can't be guided by what these people say. They seem more interested in rebuilding their reputation than necessarily making the right decisions. So we see a quite nasty recession coming in America, in Europe, and in the UK. If you look at some of the coincident indicators, we might already be in recession. Germany certainly is. About turn forced on the central banks, and we think the dollar is going to enter a major bear market starting probably either December or January. And we think the US stock market is overvalued relative to other stock markets all over the world.
Ian, is that necessarily a bad thing if it's a shorter and sharper recession? Is it a chance to sort of the Fed to reset rates?
Absolutely.
Or do you see this as a prolonged period?
Yeah, I mean, it's the worse the recession, the more they're going to panic. I mean, they've panicked on the way up, putting the rates up. If the recession really kicks in and the penny drops that they've over-tightened, they'll then panic on the way down. And so that fits in with the dollar, the shine being taken off the dollar, the shine potentially being taken off the US stock market relative to other stock markets. That's a tricky one. If you hit a recession, it's quite easy to work out what's going to happen in the bond market. If you get a recession, what bonds are going to go up in price. With a recession, if it's a mild recession, the equity markets might be okay. If it's a really nasty recession, the effects of the recession are more than offset the benefits you got from lower interest rates. So equity is potentially a tricky play. And so if you want to play equities, the relative is that UK equities are much cheaper than US equities. Emerging market equities are cheaper than US. Everything's cheaper than US equities. You want to prove that? Just look at the IPOs. Anyone doing an IPO at the moment, Arm or Glencore, Coal or whatever, they go to New York because they can get the IPO away at twice the price. Just another way of saying that US equities are out of kilter with other equity markets. So yeah, not too different from what Adrian was saying.
Let's tie it back to mining equities now. What are you looking at within your portfolio now? Who's going to win in this scenario, challenging?
It shouldn't necessarily be bad, because if the dollar falls, all other things being equal, the dollar price of gold will go up. And it's the dollar price of gold that seems to determine the performance of the mining shares. So the mining shares are completely friendless at the moment. No one wants to know. It feels very similar to the back end of 2015 when the mining shares were in a similar sort of condition. And we came in 2016. It all kicked off. I mean, our fund tripled in 4 months. I mean, it just, from being completely unloved, it was literally went overnight to being the most loved. So that's how quickly it can change. So this is not necessarily bearish for precious metals. It might be the catalyst that actually retrieves the market from its current slumber and disinterest.
Well, look, let me pivot to our companies. John, $2,000 gold. This is not a bad price to be making gold, to be selling gold, right? What's your view from the company side?
Well, just picking up from what Adrian said, it has performed remarkably well. When I think back to some of the meetings that I was having with large American funds, shareholders of ours, they were talking about 1650 gold. They were not expecting gold to do very well. In our own case, we had big shareholders asking us to really temper our capital spend. We had an opportunity more or less to be building 2 projects at once, and the very strong word from the market is to stagger that growth. To concentrate on the one project and not put our balance sheet under any stress because they were anticipating the gold price coming down and we wouldn't be generating cash flow. Well, it went the other way. And as a result, we're still sort of staying that course, but our balance sheet has continued to grow. Our share price has practically doubled since this time last year. I know in general there hasn't been a great market for gold equities. We've been somewhat of an anomaly in that regard, but driven by very, very healthy numbers. Costs for most of the industry, costs were going up. Our costs came down. Our production went up. So we were generating higher revenues, profits, and so forth, and we were able to maintain our guidance in an environment where inflation was really kicking in. I think that's the kind of story you have to have in order to do well. So you can I think still do well as a gold equity in virtually any market. And in fact, some of the you absolutely do not want to be out of the sector when things are bad. I mean, that's when you practically want to be getting invested in the sector because of how quickly it turns around. It goes from being unloved to you get a crowded trade in a matter of can happen in a week. So I think there's a good case to be made for picking and choosing your companies, and that's not very hard to do. There's not really a lot of gold equities out there, so you get positioned in the sector quite easily, and then it's a question of waiting for some of these events to unfold. And I have no doubt you're right. I do think that there's going to be a recession, and it will come as a shock to a lot of people. I don't know why, because cyclically we should have one. It's just that they've been very good at ducking it for quite some time, but they've more or less just been postponing the inevitable. Everything I remember reading about in economics, that's a long time ago. I was studying economics, but nevertheless, I don't think cycles change, and cyclically we should come into recessionary periods. That's a healthy thing for the market, and it gives you a case to effectively rebuild and get ready for the next upward cycle. It wasn't that long ago, Chrystia Freeland, who was at the time, I think she was Minister of Finance in the Canadian government. This has got to be 2 years ago, and she was answering questions regarding the amount of debt the Canadian government was taking on, and they have borrowed like drunken sailors. It's just been a mess. They took over, the Liberal government that we have in power in Canada took over one of the healthiest balance sheets that any government ever assumed, and they have just gone on the wildest spending spree that Canada's ever seen. And Chrystia Freeland was saying, well, there's absolutely nothing to worry about. Interest rates are so low. They're going to stay so low for years to come. She didn't anticipate rates rising until 25, 26. As a result, this was a very solid, very sound government policy. And look where we are now. So, and they keep on, we have a big real estate problem in Canada. All the big real estate markets are somewhat overheated. Well, mostly because the government policies have effectively either restricted or made it very unattractive for builders to build new housing, new rental properties. People can't rent in Toronto. The cost of renting is skyrocketing. Well, it's all to do with the very government policies in place that restrict investment from creating the supply that the market needs in order not to get overheated. And so now I just noticed, catching up with the newspapers over the weekend, they're talking about giving away $15 billion in rental subsidies. So, let's really restrict the market by having stupid policies, and now let's give away money so that people can afford to pay the higher rents. It's just completely crazy. As long as we have governments that are thinking along these lines, I think it bodes very well for gold.
Excellent. Ian, you wanted to jump in on that?
Just about what John's saying. The reason we think the recession will be far worse is one of the best indicators for the inflationary boom was when the central banks were printing money like confetti a couple of years ago, and simultaneously saying there wasn't going to be any inflation, if you remember. Now they're not just putting up interest rates, they're undertaking what's called quantitative tightening, which is they're actually draining the money supply. And they're doing it in the UK, they're doing it in Europe, and they're doing it in the Fed. They're running down their balance sheets. And this is causing the money supply in all these countries to shrink. The money supply shrinks, you get deflation, no disinflation. This is a danger that they're running. And that's the main reason why we think, and a lot of what John said, it's also used car markets collapsing, car repossessions going through the roof, all the things you look for ahead, and trucking employment, which is a more indicated job number than all employment, is turned. Every time trucking employment's turned down, you've had a recession. So anyway, sorry.
The telltale signs. Randy, please, we've kept you waiting.
Well, I just finished off 3 years as chair of the World Gold Council, and we run central bank education seminars in terms of teaching all the bureaucrats and economists that work for central banks around the world why they need gold. And I can tell you that last month in Austria, we had record attendance. We ran a seminar in Austria, and we had just representatives from every European government there, and a lot of outside of Europe there. We are seeing continued record attendance. And so, I think these three gentlemen have laid out all sorts of good, strong, fundamental reasons. I'm just going to say that, it's only a matter of time until everyone else realizes what most central banks around the world realize, which is this fiat currency experiment that we've been running since the 1970s is getting very close to failure. And it's a matter of, we're seeing just about every institution around the world that doesn't rely on these fiat currencies exploring how to get back to a gold-based currency. And in today's world, the technology exists to actually digitalize gold, make it very easy, very quick, very imagine getting to the point where you're confident about instant settlement in gold. Why would you not trade in something like that? And we're not far off of that in terms of technology. The technology is there. It's a matter of coming up with a system that has enough trust and provenance and fungibility behind it. We're not far off of that. World Gold Council is working on that. There's a number of institutions around, but what I like about what we're doing at the World Gold Council is the fact that it's a non-profit advocacy group that's there to do whatever it can, in the cause of supporting gold and educating it. And so here we are with gold at, near record levels. In fact, in most currencies of the world, record levels in terms of prices, and near record levels. And it sounds kind of depressing in here, to be honest. and I do think that we're setting ourselves up for some very exciting times over the next while. I think all of us have been in the business long enough to know that these are pretty healthy prices. The producers are definitely doing well. We're just not seeing the support. But when that happens, you want to be positioned well to ride that wave. And in my eyes, this is the time that we should be looking at that. So I'm pretty excited about what we're going to see over the next 5 years from a gold investor, from a gold company operator, precious metals as a whole. But I do think it's going to come at the cost of some challenges on the economies around the world. So it's not easy to I should say it's very easy to see that risk.
Excellent. We talked a lot about sort of the need and the role of gold and sort of a gold-backed monetary system, of course. What about supply of gold? What about what's coming out of the ground? What about reserve replacement? Can we delve into that a little bit? And Randy, why don't we start with yourself again? You're providing a much needed royalties streaming model for
it's
mining
interesting
companies.
for us. Obviously, at Wheaton, we supply capital to the mining industry. And I have to say that in today's environment, unless you've got operating cash flow, there's not a lot of other sources out there, right? And so we are busier than we've ever been in terms of the quantity of assets that we're looking at. Now, most of them are smaller size deals, mainly because nobody's taken the big capital plunge on larger builds, larger assets. But the other thing that we're looking at around the world is continued challenges with respect to permitting and moving projects into production, and into construction even. It's getting to the point where you really have to focus on your own assets and optimizing those, because you can be expected to have all sorts of challenges. I look at what's happening in Panama right now and shake my head. It just shouldn't happen. It's shameful, and unfortunately, issues like that scare away investors because they can't have confidence in terms of these frameworks, right? And so the supply side is challenged and getting more and more challenged all the time. Streamers can't be the only people that fund these mines. There needs to be equity support. There needs to be other investors that come into that space, and so all that again provides support for the fact that if we're short on the supply side, that's another fundamental aspect of why we're excited about what the price of gold is going to do. We're not doing a very good job of keeping a healthy market in terms of new projects coming on stream to put this metal into the trading environment. So,
John, how do you see reserve replacement? You've got cash. Is there a renewed pressure to put that into new exploration? Certainly the explorers would need the majors and the producers to be looking down the chain.
So if you look at the global spend on mining exploration, it's been going down year after year. I think statistics show that there's roughly $6 billion spent worldwide on exploration, and a huge portion of that went into gold exploration, strangely enough, because when you think about the big story out there in all the press is it's all about battery metals and so forth, but it's been the gold sector that has been by and large spending money on exploration. But if you compare it to say 10, 15 years ago, it's the spend is a fraction of what it used to be, and the big missing element has been the junior end of the market. That was the end that was largely financed through retail investment, which is more or less missing from the sector right now. And they used to drive a lot of the new discoveries as well. And this is one of the reasons why I think we haven't seen that many real exploration discoveries. And frankly, when they occur, it unlike previous years, every now and then on my LinkedIn feed, I get these stories popping up from the 1990s. Recently, I was reading about the Hemlo discovery in the 1980s, the Arequipa discovery in the 1990s. These were huge wins where the stocks went from literally pennies a share to tens of dollars a share, if not hundreds of dollars a share. And investors made incredible money investing in the junior sector at that point in time. I can't think of too many stories like that. I think of in our own case, we took over a junior in 2017, small producer, we were we faced a huge headwind in the market just for doing that deal. But they had made a really interesting discovery, which in a previous market, I think people would have really understood. The analysts would have given it a much better coverage. It would have received press. It would have been a story. And this time around, it wasn't. This happened to be unfolding in 2013, 2014, when the market just couldn't care less. Gold prices were coming down. They dropped from something like $1,900 an ounce. They hit a low of just under $1,100 an ounce in early 2016, and that was the period of time when these guys were starting to get into it. We took them over in 2017. We put a serious budget into exploring something that they were never able to do because they didn't have the capital. And within 3 years, we took that asset from something like 1.5 million ounces in all categories to 5.4 million ounces, and it's still growing. Now that's a significant discovery, but outside of a very small circle of investors that follow the sector, nobody's heard of Island Gold. But there was a period of time, well, unfortunately it wasn't real, but you remember everybody talking about BRIEX? I mean, I ran into grocery store clerks. Oh, you're in the gold mining industry. Have you heard of BRIEX? Oh, no, I've never heard of that one. It was like that though. And unfortunately it was a major scam. And you talk to people that have had a minor brush with investing in the gold sector. They'll all remember that BRIEX story. And that doesn't do us any favors, that's for sure. But in terms of what I think is ultimately going to come back, I think you're going to see the junior sector come back again. It's going to take probably something like a healthy $2,000 gold price, well over $2,000 and well supported. And I think at that point in time, people are going to get interested in the commodity again, and the junior sector will revive. For the time being, it's running on fumes. And if it wasn't for the companies that have capital investing in juniors, like we've probably invested in something like 10 or 12 different juniors over the last few years, and we've kept their exploration programs funded. Companies like Randy's have stepped in and funded the development of projects, but that's never going to be enough. We need a healthy support from a much broader spectrum of investors, and it's not there right now. Yep. And I think it's going to be a while in coming back, and it certainly won't come back before we see higher gold prices.
Yep, sustained higher gold prices. Ian, what about valuation in juniors and the opportunity?
I think also, along with maybe a weaker dollar and higher gold prices, the key to getting the small investor back into investing in this sector is to get them out of money market funds back into the market. So at the moment, there's something like $6-7 trillion sitting in 2-year Treasury bonds and money market funds getting 5% yield, and they don't want to do anything else. They lost so much money in 2022. They've all gone mega risk averse. They lost money in bonds. They lost money in Facebook. All these things, they got wiped out. As a result, they lost all their risk appetite. They got into money market funds. There's now knocking on $7 trillion in money market funds. If, as we suspect, and I think the panel sort of seems to think that as well, that the rates start to come down. The recession kicks in and they don't get 5% anymore. All of a sudden, they don't even get 4%. All of a sudden, it's looking like 3%. And all of a sudden, that entire $7 trillion is going to start looking for other things to invest in. So the feast-famine nature of this market, at the moment, it's on famine. But the minute the rates come down and they're not getting 5% of the money market funds anymore, they'll start looking, and the 2022 becomes a more and more distant memory. They'll start, they're looking for a reward side of the game, not the risk side. And you'll see investors move out. And you don't need much of that $7 trillion to go into gold mining shares to have a really significant effect. So we think it's, again, coincided with a weaker dollar. coincided with a higher gold price. The other key is to get some of this money out of these money market mutual funds back into the stock market.
And just come in on that, Adam. Hey, Randy, you mentioned about, WGC looking for, developing a gold market product where you got instant settlement. You've got instant settlement on BullionVault. You've had it since 2005. Why is BullionVault $4 billion worth of client property? Because people want the safety of it. People want to own the physical. And if you look at the growth of the ETFs, I've heard people say, the WGC kind of hoisted themselves here by developing a product which enabled people to buy price exposure, whereby they didn't need the mining equity anymore to access the gold market. And I think what's been missing from the gold market, certainly so far this century, really, is the speculative element. You mentioned it, John, in terms of in the 80s and 90s, those big discoveries and, that real excitement, particularly on TSX, particularly in, North American explorers and juniors, the gold price was falling. There's an underlying bear market in the gold price there, but you had that speculative excitement and you had those stories and you had that opportunity that people was, the idea people were sold on that they could buy a junior, this could go to the moon. And it seems to me at the moment that, where precious metals have now got to is precious metals are about safe haven. Look at gold versus silver. Gold's outperformance of silver across the last 20 years. And then, where's my moonshot? And that's where the juniors used to come in. And I think that's what's been missing in the market in terms of real capital allocation, real inflows, is that, you're lacking that narrative, that idea that actually, this could be a
It's like investors have, they've largely gone to crypto to find that. That's
so is the new silver, right? I mean, that's what happened 5-6 years ago was, everyone was, crypto's the new gold. No, crypto's the new silver. That's what happened.
Let's keep going with the silver discussion though, because we haven't touched on that. We want to cover precious metals. What's the if crypto's the new silver? What's the view on silver from here? Lacking some major discoveries to sort of bring the attraction and incentive back for that. Ian used to be very bullish on silver, but there weren't too many companies. Randy, you were gonna please.
Yeah, sure. About 40% of our revenue comes from silver. We originally started as a silver streaming company, and so silver is important to us. The one thing that's unique about silver is that the bulk of silver does not come from silver mines. There's actually very few silver mining operations in the world. About 25% of silver actually comes from silver mines. The rest of it is a non-core byproduct from mainly lead zinc mines, actually. And I can't remember the last time a significant lead zinc mine got built in this world. Copper mines also have healthy byproduct production, and of course gold is in there too. But so again, fundamentals on the silver side, I think look spectacular outside of the fact that we're missing the retail investors and the central banks aren't buying it. And so on the demand side is where the weakness is coming from in silver. But even on that side, industrial applications continue to move forward. The one attribute about silver that is always important to remember is that it does conduct electricity better than any other noble metal. And so as the world continues to focus more and more on greening and lessening our own footprint, what that drives is demand to have more silver involved in electrical circuitry boards, solar panels, all the way across board, even antibacterial applications, the water purification systems and such. Silver makes everything better, makes it more efficient, makes your phones last longer, have higher processing power, makes your electric vehicles drive farther. And again, it's just less waste of energy whenever silver's involved. And so again, all the fundamentals are there. The only thing that's missing is that retail demand side. And if you go back and look at what silver's done, silver always lags gold. Always does. Every time you've ever seen gold go for a good run, you go back and look, silver is usually a couple of years or a year behind that start on gold, but then it outperforms. It's the beta that silver has, the high volatility that it has that attracted the crypto. Or it gets, why it gets compared to the crypto investors is that high volatility that it has had for forever. And so yeah, I mean, I always feel that, about the time that the differential is the biggest between the two is probably about the time that, if we start seeing gold going for a move, that's always a healthy time to be invested into the silver space. And so, again, the fundamentals are there. We've seen peak silver production. And in fact, I think we saw it back in 2017, 2018. It's been dropping worldwide ever since. That, combined with increasing industrial demand, where I think it's over 60% now gets put into industrial applications. All of that sort of spells to eventually awakening up as we shift back towards precious metals as a store of value and a measure of value on a go-forward basis. And so it's a matter of just making sure you have good access to quality silver production when that happens. So.
Excellent. Another view on silver?
But I think the way to play that is probably through Wheaton rather than through the silver producers. That's the problem, and I think that's
why is that a problem?
Well, for the silvered equities, I was going to say
there's not enough.
If you're a junior
producers,
and you're thinking about mounting an exploration play for a silver project in Mexico right now, your chances of raising that capital is very slim. And there have been some fairly interesting discoveries on the silver front in the last few years, but they just haven't received any traction. And I think it's because I know if I were going to do it, I would buy a silver Wheaton as opposed to a silver equity. There's far better chance of there's far less risk and there's far better chance of your investment appreciating. So this is something that that really dogs the sector right now, and it's been a real risk-off market as far as the whole junior end of the market is concerned. That is going to catch up as it did in the 1990s. Probably remember that. Very little money went into mineral exploration. Very few students went into mining engineering, geology, things like that. So where do we find ourselves by the time we got into the late teens? Everybody was looking around to hire geologists and mining engineers, and we couldn't find them. And that shortage is still out there. And the deposits that might have been discovered in that cycle but weren't because nobody was spending any money. Well, we've still got that problem. It's still sort of making its way through the market, and most of the things that are counted as the late discoveries that are now the producing assets, including our own, they're actually very old discoveries that just lagged for a long time until they were properly capitalized and turned into something real. But you could see the early stages of those discoveries going back a couple of decades, really. So when do we get something new happening? I don't know. It's not going to come until you've got a healthy junior sector. We see some interesting little juniors that are exploring in parts of the world that you've never heard of, and they're largely ignored. We're investing in some of those companies, but that's not something that the general market is going to be interested in.
Yep. That would be my final thought and question. Is this an environment shaping up for more M&A, given where valuations might be, that kind of thing, in terms of what you're doing, putting back into the explorers?
Well, with respect to what we're talking about, the lack of investment in the junior exploration sector, I don't think M&A really plays much of a role in that. Not until there's a significant discovery made, and those are very few and far between. Where you're going to see further consolidation, further M&A is in the mid-tier space. It's you'll see companies out there with, say, one producing asset, and their ability to turn that into something more is quite restricted, and it's more than likely that they'll get taken over by a company that has a little more on the go, 4 or 5 producing assets, and then companies mining 4 or 5 different mines, they're likely to get ultimately taken over by the bigger ones. So every time every fish that's that's on the coral reef looking for something to eat. He's paying attention to what he's interested in eating. He doesn't see what's behind him, and that's something that I never want to lose sight of as a CEO of a mid-tier. Yes, there's a lot of we've been quite successful in acquiring companies and turning those assets into profitable mines, and so I'd love to do that again. But in the meantime, I know full well there are companies behind me looking at, oh, look at that. We've got a growth in reserves, growth in production. So we're going to be attractive to the company that's the next tier up. And the reason why it's going to happen is if you take the aggregate of the entire sector, that's every major from everywhere in the world, I think we're capitalized at roughly 50% of, name your top company in the Fortune 500. The entire sector is capitalized at less than 1/2 of one of those companies, Philip Morris or something like that. And it means the capital markets have grown dramatically and the mining sector hasn't. So on a relative basis, we're tiny and largely overlooked. I don't think that changes until commodity prices for gold, silver, and other metals. I think we're going to need improvement right across the space.
Yep. Ian would sort of
Quickly, yeah, just one point I forgot to mention. Something else not helping this sector at the moment is a bit like 2015. Is most of the shares are held by US investors. It's tax loss selling season. So a lot of the selling you're seeing at the moment is just the registered tax losses. So once you come into January, all that tax loss will be over. So that'll be a weight that's taken off the share market.
Yep. Randy, just finally, is it higher prices that are going to change this? And do you have any thoughts on the M&A discussion we just had?
Yeah, I mean, to be honest, there's some really good opportunities down in that junior developer. It's the challenge is finding good projects. But I mean, we were partners with Sabina on the Goose project in Northern Canada. I do think, again, going back to my comment on permitting and how challenging that was, until they got the permits and broke ground, that's when it became attractive. Sometimes the smaller companies have an easier job in terms of getting support from the local communities, the local stakeholders, in terms of moving forward versus the big wallets of a multinational or even a mid-tier diversified company that's got a number of assets around the world. And so we have seen a lot more equity investments, as John mentioned. A lot of companies are taking advantage of the fact that these single project or single asset project development companies, they're trading at valuations that are impossible to ignore. And so keeping your nose to the ground in terms of looking for the needle in the haystack in terms of good projects, there's always going to be a market for that, and that'll drive that. And so we've seen that. And at these valuations, there has to be some M&A, coming out of that. It's a matter of just picking the right asset.
Okay, well, gentlemen, look, that's brought us to time. Some really, really interesting expertise shared there. Hope everyone enjoyed that, and thank you to my panel.